Well, the beginning of January brings us closer to bank earnings, and joining us right now with his outlook for financials is Kenneth Leon. He is CFRA's Director of Equity Research. Ken, what do you think in terms of what to anticipate for the financials in 2026?
Well, it's great to be with you, Becky. And banks are critical, mostly because if we're going to get breadth in the U.S. equity market, financials are critical. And when we look at the weighting, what drives the financial sector, there's roughly 12 stocks that are about 65% of the total sector. The six largest banks that I cover are in that list. And we think that the outlook is going to be very positive. One of the themes that we have at CFRA is about earning your multiple or valuation. And we think that there's good opportunity, as we'll see first with the fourth quarter results in early January report, but for 2026 of upward earnings revisions. And I think that's going to be most critical. You can check the box. We have a rate environment from the Fed that's either rate cut or rate pause. We're seeing a steepening yield curve that's improving net interest margins. Loan demand, the U.S. economy still is very good, 2 to 3% growth. That means that we're going to see healthy growth in the traditional parts of the bank. But our call at CFRA was really the delta for earnings has been the capital markets. And we saw in the second half of 25, but really leaning into 2026, opportunities for very good investment fee income from M&A, also from equity underwriting. And by the way, IPOs, even in 25 with that second half surge, was $146 billion, up 30%. So I see really good opportunity for not only bank earning performance, but also for share price performance for this group, which is critical for financials and critical for the stock market.
You know, Ken, certainly that anticipated active capital market story is very much animating the stocks, right? So I'm looking at a Goldman Sachs. Amazing performer. Obviously, a lot of the fundamentals are kind of in a sweet spot for them, but it's now 2.4% book value. Hasn't traded up there since before the financial crisis. Are we kind of paying up front for a lot of these good things we're expecting?
Yeah, bank analysts are kind of a nervous conservative group. And, when you look at things like price to net tangible book value, Mike, they're expensive. I kind of lean into forward price to earnings and just look at the opportunity for surprises on estimate revision, which is critical. That's worked so far. I think, again, that when you look into next year, we're just seeing particularly in investment banking and all the CEOs were at financial conferences back in November are really painting a pretty good picture for next year. Additionally, here's the key, Mike, is that from the regulatory side, and most investors don't pay as much attention to what's happening with Fed supervision and regulation. We will see for the first time, maybe in 15 years, some easing that allows the banks on capital release, not buildup, which means possibly buyback and also higher dividends. We haven't had that for a long time. The Trump administration has been very favorable to easing on bank regulation and pushing back other countries on something called Basel III endgame rules, which is just onerous to the U.S. economy.
Gotcha.